This is the cleanest 5-minute scalping setup I've ever used because it's built on one thing that the market always does, and that is sweep liquidity before it moves. If you're only going to trade one scalping setup for the next 30 days, make it this. This is your sweep strategy. Simple rules, repeatable entries, and it stops you from chasing random candles. My name is Brett Gold. I've been trading for 7 years. Last year alone, I made over $2.2 million in trading profits, and every single trade is documented live on my second channel, Brett Trades. I've also helped hundreds of students become 6-figure funded traders inside my mentorship program, 1% Club. And I'm also the founder of EdgeFlo, a discipline-first trading platform that helps traders execute cleaner with guardrails, journaling, and performance tracking. So quite simply put, I don't want your money, I just want you to become a better trader. Let's dive in. The strategy that we're going to be using today is the Asia sweep strategy, and the concept is super duper simple. Basically, during Asian session, price tends to form a range, which means price tends to go sideways, right, and stuck in this consolidation just like this. And when this happens, this is where we can draw a box. And then when London session opens, price tends to take out either the Asia low or the Asia high, and then it start reverses, right? So for example, in this particular case, price will come out there, take out the Asia high, and then just start reversing just like this. And this is the move that we want to be trading. This is the move that we want to catch. Basically, we want to catch the liquidity sweep and the snapback itself. That's the whole strategy. Now, the question becomes, how do you mark up your Asia high and your Asia low? Most people mess this up, but let me make it stupid simple. Because I believe that if you cannot explain your trade plan simply, you cannot execute it consistently. And if you cannot execute it consistently, you will not get consistent results. Remember, the goal is not to sound smart. The goal is to be consistent. So the first step is that you pick one Asian session window and you just stick to it and you never ever change it. If you are based in the US, which I assume most of you guys watching this are based in the United States, here are two clean options of the Asian session window in Eastern Standard Time. So based on where you're in the world, right, make sure you do your conversion, right? But basically in Eastern Standard Time, the Asia range will usually be around 7 p.m. to around 3 a.m. Eastern Standard Time. So this forms my Asia range. Now, if you want a much more tighter box and you want much more cleaner liquidity sweeps, what you can do is to narrow it down to 8 a.m. Eastern Standard Time to 1 a.m. Eastern Standard Time. Okay, like this would be like a much more tighter range, which also means that you can expect price to sweep that high easily. That is formed during the Asia range right here, and it's honestly like the same thing, but like if you want just like a much more tighter box, this is what you can potentially do. Okay, but for simplicity's sake, I'm just gonna stick to the first option, which is indicates that Asian session is from 7 p.m. to 3 a.m. Eastern Standard Time. Now that I've marked up this time window, right, which is the Asian session, by the way, you can indicate the Asian session by using these red lines just like this by going to trading view and clicking like this vertical line right here, and you can place it at whatever time that you want. And in this case, like I said, I've placed it at 7 p.m. and 3 a.m. Once that's done, I want to identify my Asia high and Asia low. So your Asia high is basically the highest wick that is printed during this window, right? So if you look at this entire window, there's a lot of candlesticks in here, right? What you want to do is to identify the highest wick, okay? The highest wick. So in this particular case, this is the highest wick itself. Now that we have identified our Asian range, the next thing you want to do is to identify your Asia high and your Asia low. The Asia high is the highest wick that is printed during this particular window itself. So if you look at this entire range right here, there's a lot of candlesticks over here, right? Basically, what we want to find is the highest candlestick, the candlestick that is situating at the top. So if you look at all this, okay, which one is the higher? This one is quite high, but this one is actually even higher, because the wick actually came all the way up here before coming down here, right? So this is the highest wick, which means that this is actually our Asia high, right? So you can indicate it with like a line just like this to signal to you that, okay, if price comes up there, it could potentially sweep the Asia high, and then we can potentially see a reversal. And this is the move that we want to be trading. And then what about the Asia low, right? The Asia low is the exact same thing. You just want to look for the lowest point during this window. And ideally, it's the lowest wick that is printed during that window. Once again, not the lowest body, but the lowest wick. If you look at all these candlesticks right here, where is the lowest candlestick? Right, this is the lowest candlestick. And do you mark it up right here at the candlestick body? No, you mark it up at the lowest wick, right? So this is the lowest wick. So this is where? This is our Asia low. This strategy is literally built around stop liquidity sitting above these highs and below these lows. right? We are pretty much assuming that people who enter for longs right here, they're going to be placing their stop losses below these lows, and people who enter for a sell right here, they're placing their stop losses above these highs, right? So that gives us the available liquidity that smart money can later use during the London session to cause price to reverse in the desired direction. So there are three conditions in which I will not use this particular strategy. Number one is when the range is way too wide, right? So if the range is like super duper wide, no go, right? Because this means that price has already moved a lot and the sweep can become very messy. Yo, quick pause from the video. If you've been watching me for a while but you are still not consistently profitable or making the money that you want from trading, listen up. From March 24th to 26th, I'm running a 3-day live trading bootcamp where I'm teaching the exact habits and mindset shift that took me from losing tens of thousands of dollars to now making millions a year. It's the exact same mechanical trading system that helped over hundreds of my students go from inconsistent and unprofitable to now getting funded and consistently making anywhere from 10k to 50k a month. Because here's the truth. You probably already have good enough strategies to be profitable, but the real reason that most traders still lose money is because they don't understand how the market works and they never fix the habits and psychology that's keeping them broke. And that's exactly what I'm solving with this 3-day bootcamp. Anyways, tickets are now live and on early bird pricing, so grab yours before the price goes up. It's the top link in the description. Now let's get back to the video. The second condition is that if the range is too tiny. For example, if price just do this, right, just not really going anywhere, there's a lot of small candlesticks. You can't identify the high and low easily because price is just like a tiny little boy right here. This is where you will see a lot of fake outs and there is just no real liquidity, right? So it's very difficult to be trading the Asia sweep strategy when the range is extremely small. And the third condition is where there is no range. Okay, so if it's just trending very cleanly, like price is just going up just like this is not the time to use the Asia strategy, right? We only want to be using it when price is consolidating, going sideways. So if any one of those three conditions appear when you have marked up the Asian session window just like this, then there's a no-go. And also, here's a pro tip, okay? If you notice there's like one weird spike wick, here's what you want to be doing. You want to be marking the high of the wick, if it's the Asia high, if it's the Asia low, you want to mark up the low of that super long wick. And you also want to be marking out the range level where price respected multiple times, right? So if you look at this range right here, price went up there, pull back, goes up, pulls back, goes up, pulls back. Somewhere around here, this is also a level where price tends to respect. So we can expect price to swap that level and then start reversing down as well. Okay, it doesn't necessarily have to come all the way up to this extreme wick that is situated at the swing high right here. Okay, like price can come out there, sweep this. This is technically counted as the Asia high because this is the range, this is the level where the range respected multiple times during the Asia range and then just start coming down as well. So in this particular case, this would be the Asia sweep high. This would be the extreme Asia high. If the extreme wicks is down here, right, you can do the exact same thing down here, right? So this might be the extreme Asia low, and then this could be like the Asia low. So the next thing is that after you have identified your Asia high and Asia low, now it's time to trade it. Okay, but it's important for you to know when to trade because, like I said, this is called the Asia sweep strategy for a reason, which means that you're not going to be trading all day, which also means that you're not going to be trading during the Asian session. You want to be trading right after the Asian session. You want to be hunting the liquidity sweep, okay? Because like this is the timing where liquidity tends to get raided. So the best time to use this strategy is during the London Open. 3 a.m. to 6 a.m. Eastern Standard Time. These 3 hours, this is the best window to be trading this strategy. This is the window where you will see the cleanest liquidity sweeps, the cleanest reversals. So let me give you a quick recap of everything, and this is the entire checklist that you can potentially use, right? Basically, there are just 5 steps to follow. Number 1, mark up the Asia box, right? So this is where you identify the Asia range, which is from 7 p.m. to 3 a.m. Eastern Standard Time. And then once that's done, you will be able to identify your Asia high and your Asia low. Okay, so if you want, you can even mark up like a box, right? Just like this, mark up the Asia high and the Asia low, right? This is pretty much the entire Asia range. Number 2, you want to wait for the liquidity sweep. Okay, so at this point of time, at 3 a.m. Eastern Time, when our London session actually opens, ideally, I want to see price take out either the Asia high that I've marked up right here or the Asia low. Once again, not just touch it, right? But actually take it out, actually swap the liquidity below it and then move in my desired direction. Okay, so in this particular case, let's see what happens next. All right, 3 p.m., 3 a.m., the London session has just opened, right? And right now price is slowly coming down to the Asia low, right? So you can see the minute it approaches the Asia low, this is where I can like jump down to my lower time frame to look for my entries, right? So let's just go back a little bit right here. Okay, so you can see as price starts coming down here, this is 15 minutes into the London session, and you can see price is not coming up to the Asia high, right? So I'm not going to be paying attention to what happens right here. Price is approaching the Asia low, so I'm going to be paying attention to what price does at the Asia low. So this is where I go down to the 5-minute time frame, and like I said, this is the Asia low itself. So I want to see that get taken out during the next 5 minutes or so. If you are even more aggressive, you can even go down to the 1-minute time frame itself, right? But basically, we just want to see this get taken out. So let's see what happens next. Okay, price eventually comes down, consolidate here a little bit, consolidate here, do nothing, and then eventually it comes down and take out this Asia low. You can see the minute price comes down and break past this 1.34830 level, this is where we got our Asia liquidity sweep, right? The Asia low liquidity sweep right here. Which brings us to step 3, which is we want to wait for some form of strong re-entry back inside this range itself. Okay, so we want to see price comes down, create a sharp V-shaped reaction, which indicate to us that this is indeed a proper liquidity sweep. And then we want to see price start going back into the range itself, just like this. And it needs to push back into the range with force. Okay, not like drifting around here, not chopping around here. No, I need to see that sharp V-shaped reaction, which indicate to me that smart money has swapped liquidity and now they are using all the available demand to push price to the upside. And then step 4 is the entry trigger, right? So ideally what I'm looking for is for the liquidation candle to have some form of long wick, right? It could be a long lower wick if it's sweeping the liquidity below the Asia low, and then it will be a long upper wick if you sweep the liquidity above the Asia high. Or sometimes it could even have the candlestick body closing below the low just like this as well. That works as well, right? But basically, I want to see price reject this level clearly after it has swept this low here. And then once that happens, I want to see a clear displacement in the opposite direction. So when I see this sort of pattern, right, liquidity sweep right here, indicated by the liquidation candle, and then having like a reversal candlestick just like this right here, indicating there's a lot of displacement, a lot of momentum, a lot of buying pressure pushing price up. This is where I would potentially look for longs right here. And the 5th step is to place your stop loss and your take profit. You want to be placing your stop loss below the liquidation candle, right? So this is the liquidation candle, and you want to be placing it a few pips below the lower wick of the liquidation candle itself. Once again, you want to give it a little bit of breathing room, because what can happen is that price can come down here, retest this level and go up. And if you don't give it a little bit of breathing room, your broker could like cause you to get out of this position because of spreads. And then for your take profit, you want to just place it at 2R. Okay, so for this strategy, I'm just gonna keep it simple. Just place it at 2 times your stop loss, right? So 2 times is somewhere around here. Okay, you can see this is 2 times my take profit. So I'm risking $10, I'm getting back $20 in return. If I'm risking $100, I'm getting back $200 in return. And that's it, right? So those are the 5 steps. Let's look at how the trade plays out. Eventually price goes up there, smash my TP, as simple as that, right? You can see it's literally not a rocket science. I believe that I've simplified it in a manner where even like a 5-year-old can understand, right? If you follow these 5 steps, you will be able to just catch these very nice aggressive entries right at the start of the London session itself. Once again, it's important for you to understand what time that you are trading, right? Because liquidity is the fuel, timing is the ignition, right? So in this particular case, the only reason why this strategy works so well is because price came down, swept liquidity, okay? That's the fuel. And then at London Open, this is where the institutional traders who are trading the London session is also very active, right? So this is where they join in on the move and they cause price to move up significantly just like this, right? So you can see liquidity plus timing, that's what makes this strategy works. All right, so now let me show you another example of this strategy itself. So first step is to identify the Asia range, right? So what I will potentially do is that I'll come here, take out my little vertical line to just like this, and I'll find the 7 p.m. which is around here when the Asian session opens. until 3 a.m. when the Asian session closes, which is around here. After I identify the Asia range just like this, I want to identify my Asia high and Asia low. Okay, so clear as day, I look for my Asia low, which is the lowest point, the lowest wick during this range. And you can see it's very obvious, right? If you look at this is going to be the lowest candlestick. Once again, do you mark up at the candlestick body? No, you don't. You mark up at the lowest wick. Okay, because this indicates the lowest point price went to during this Asian session itself. And then you also want to mark up the highest point, right? That is your Asia high, which is somewhere around here. So Asia high, Asia low, that's it. Ta-da! Now we just do nothing until any one of these gets taken out, either the high or the low. Okay, so this is where London session has already opened, and we are already like what? We are already like 1 hour into the London session, and you can see price have not swept Asia high and low yet. So we continue waiting very patiently, right? Because this strategy only works after price sweep Asia high and low. If it doesn't, then it doesn't, right? Then we are hands off. Then we are just waiting for the opportunity itself instead of forcing trades. So at this point of time, it's very clear that price is coming up here to sweep the Asia high, since it's quite far away from the Asia low. So this is what I'm paying attention to, right? I'm going to be paying attention for the next few minutes to see what price does. Boom! Asia high has officially been swept. The minute price have swept Asia high, this is where you can go and look for your entry itself. You can see this was super duper aggressive. Right after price took out the Asia high, price started reversing straight away. Like literally within 60 seconds, price did this huge move to the downside. So at this point of time, if you were super duper aggressive, what you could potentially do is that you could have gotten in like somewhere right around here. Okay, so you don't even wait for the displacement, you don't wait for the V-shaped reaction, you got in right after price of liquidity above this high, and you just get in somewhere around here, place your stop loss above the wick, and then just place your take profit at like 2R or something. Yeah, you have smashed your TP within like 1 minute. Okay, so ideally, this type of scenario is very, very fast, and more often than not, this is really for people who are super duper aggressive, right? Like you are just willing to enter right after price with Asia high and Asia low. This is the type of move that is for you. But like I said, we want to look for entry confirmation. And in this particular case, if I look for entry confirmation, I want to see a liquidity sweep right here. And then I also want to see a strong displacement in the opposite direction, right? Which indicate to me there's a lot of bearish momentum. And that happens, and the candlestick eventually close right here. But the thing is, if I enter right here and I place my stop loss above this high here, you can see the take profit is not very ideal, right? Because the 2R take profit has to be all the way down here. And the thing is, it doesn't really make sense, right? Because right now price can just make a tiny pullback just like this and just continue blasting right through it, right? So this is not a trade that I personally would take if I am, once again, just sticking to my trade plan, waiting for the entry trigger to appear itself. We did got our liquidity sweep and we did got our displacement, we did got our entry trigger, but in this particular case, the risk to reward is just not asymmetric, right? I just don't like, like to play in these games where I know I could potentially lose, right? So let's see what happens next. Okay, you can see price continue going up because right now there's a lot of bullish momentum, right? And just blast right through your stop loss. So if you did enter for this trade, it would be not the best trade, right? Because like it's kind of too late since price has already made this move, right? Since smart money has already used the liquidity above these highs to fuel this move to the downside right here. So if we get in right here, a little bit too late. Okay, but let's continue to see what price does. Because now price has potentially came up here, and guess what? This is where right now price could potentially come up here and sweep this high right here. Okay, this is where it gets a little bit nuanced, right? I wanted to show you more examples. I don't just want to show you like the basic example and just cherry pick scenarios where price just sweep Asia high and low and just go in one direction. No, I want to show you different examples, different scenarios, so you know exactly how to handle them as you approach the market, right? Because the market is not going to be as easy as, okay, price sweep Asia high, boom, start going down. No, there's going to be different scenarios. So I want to make sure that you are well prepared for those. Now, I want you to pay attention to what price does right here. Over here, since price has swept this liquidity, price has used this available liquidity to fuel this move to the downside. So this liquidity has already been used. The next question becomes, where is the available liquidity next, right? That price can potentially take before it starts making this reversal again. Well, since this one has already been used, it cannot be used again, which means that the next available liquidity is going to be above this swing high right here. What you can potentially do is to wait for this high to get taken and then trade the reversal of that high itself. Okay, so in this particular case, what do we have? We got a V-shaped reaction, we got a displacement, right? We got bearish momentum coming to the downside. This is where you can potentially look for shorts. You can place your stop loss above this high right here and place your take profit at 2R, just like this, and you can see price played out perfectly. Now, I want to show you one final example, which is once again out of the box. So in this particular case, we have done our first step, Asia range, and we have identified our Asia high and also Asia low. Okay, cool, that's done. Now I want to see either one of these highs or lows get swept, right? So let's see what happens next. Okay, price comes down. Okay, it seems like it's obviously like coming down and sweeping this low right here. And the minute it took out this low, boom, go down to your lower time frame itself and observe what happens next. All right, so prices came down and took out our Asia low, but it did not start reversing straight away. You can see it wasn't like the first example where price just came down, take out the low and just reverse. No, it wasn't like that. In fact, it continued going down even further. Okay, so this is one of those examples where you don't just want to blindly just enter for a buy just because price has like take out this low. Okay, this is where a lot of beginners, they make the mistake where, oh, price is taking out the Asia low, cool, I'm just gonna enter for a buy straight away. And the next thing you know, they place a stop loss below this low right here, and then boom, price continue going down and they get stopped out. All because they were trying to catch a falling knife. Right, you must understand that when price goes down, it can just continue going down for an extended period of time before it starts reversing, because there is just so much selling momentum in the market itself. There's just so much selling pressure in the market, right? So if you try to enter for a buy right here, once again, you're trying to catch a falling knife, and that's going to be very, very painful, right? You're going to get cuts on your hand itself. So we don't want to do that. So when price take out the Asia low, what we want to see is price to start reversing. If it doesn't, we don't enter. Okay, like I said, you want to look for entry triggers, which is the V-shaped reaction, the liquidity sweep, and the displacement in the opposite direction, which is some form of confirmation candlestick that tell us that, you know, there is actually bullish momentum in the market. The price is actually reversing. If you don't have those, we do not enter. Okay, so in this particular case, over here, I don't enter. Over here, I still do not enter. Over here, this is where I start getting interested. Okay, you can see clear as day, prices came down, massive liquidity sweep, right? It's potentially even sweeping some liquidity below this low that was quite far away, right? And also clear as day, we got a displacement to the upside. So at this point of time, this is where if you want to be aggressive, yes, you can enter for a buy right here. Because we got our V-shaped reaction, we got our displacement candle, which indicate there's momentum pushing to the upside, right? So you can enter for a buy right here, place your take profit at 2R, just like this, okay? So this is if you're aggressive. Once again, I want to give you another option if you're conservative, because not all traders have a high risk tolerance. Some traders, they want to wait for extra confirmation. They want to, know for a fact that price is actually moving to the upside before they actually enter for a buy. And then the question becomes, okay, how do you know for a fact that price is going to shift to the upside? All right, so first of all, let's just let the aggressive trade play out, right? Let's see whether price eventually goes up there and smash our TP. Okay, price eventually goes up there, smash our TP. Okay, so aggressive example. Now, let's time travel back to our entry, and this time around, let's say we do not enter over here. Okay, we don't enter here. We want to wait for extra confirmation that tell me that price is potentially going back up, right? So over here, I still do not enter. Boom, this is where I start getting interested. Okay, boom, start getting interested, right? Boom, this is where, what is the market trying to tell us right now? At this point of time, the market is trying to tell us that, okay, price is pulling back here, is creating a lower high, or at least yes, attempted to create a lower high. Now, if there's sufficient supply in the market, what could potentially happen is that price can create a lower high right here, comes down, take out this low, and create a new low. Okay, these tell us that the bears are still in control of price. The market is still bearish. The internal order flow is still bearish. Okay, but that did not happen. In fact, price failed to take out this low right here. And when it failed to take out this low, it created what I call a failed reaction, right? Where instead of coming down and take out this low, demand overpowered supply, and it caused price to reverse and head back up, creating a new higher low, right? So at this point of time, this is where you can see the structure start shifting from bearish to bullish. This is the confirmation that you're waiting for if you were conservative, right? So if you're conservative, what you can potentially do is that you can enter for longs right here. Once you see this failed reaction, once you see price creating a higher low, and you have seen price, swap the liquidity below the lows right here, right? V-shaped reaction, displacement to the upside. This is where you can place your stop loss below this low right here. Or if you want to be even more conservative, you can place it below the liquidation candle. But for me personally, if I'm entering on a failed reaction just like this, I would just place my stop loss below the failed reaction, right? Below the new high low right here. Because once again, you want to be placing a stop loss at a price point which invalidates the trade idea. So if I place my stop loss right here, what I'm essentially telling myself is that, okay, if price comes down here and they take out this low, then my trade idea is wrong. Which is true, right? Because if for some reason there is still enough sellers in the market to push price down, what will happen is that price will later come down and take out this low here, okay? And if you take out this low, then it will just continue bearish. So yeah, this is where I would want to get out of if price starts shifting bearish. All right, so that's my stop loss. Take profit as usual, just set it at 2R, set and forget, just like this. And let's look at how the trade plays out. Right, slowly but surely comes up there and smash a TP. I'm going to leave it up to you to choose whether you want to go for the conservative entry model or the aggressive entry model. But my advice is you want to be testing this entire strategy over the span of a large sample size, right? You need to gather so much data that is unreasonable that you do not trust your trade plan. And that could be taking 100 trades using this strategy or taking 1,000 trades. And then based on the data that you have gathered from these 100 trades, you can evaluate which entry model works the best for you, whether that's the conservative version or whether that's the aggressive version. And then as you analyze the data, you will also find out which currency pair tends to follow this strategy really, really well. Which timing does price tends to sweep the Asia high and low, right? So it's all about just putting in the reps, reviewing the reps, gathering data, reviewing data, and just continue to iterate a trade plan. That's the name of the game. Trading strategy is like an asshole. Everybody has one. The hard part isn't making a strategy. It's sticking to it when it stops working temporarily and having the patience to follow it long enough to prove that it does. And that is why the rules of the trade plan matter more than the setup itself. So if you want this strategy to be proven, you want to have rules installed into your system. And it will be even better if you have a platform to enforce these rules. So this is EdgeFlo, which is the trading super app that I've built to enforce these guardrails. Right, so in EdgeFlo, if I want to be trading this Asia sweep strategy, I want to make sure that I have some rules within my trading system rather than relying on willpower and discipline, right? Which is quite finite and it can only allow me to go so far until I start getting emotional and I start losing control, right? Once again, when you use EdgeFlo, control is literally built into your trading system. For example, the first guardrail I have is max trades per session, because when I'm using this strategy, I only want to limit myself to 2 tries, right? 2 bullets. Which means that if I take the first trade using this strategy and it failed, I'll try again. And if I fail the second time round, I will stop trading for the day itself. So on EdgeFlo, you have the ability to set your max trades per session, right? So in this particular case, I set it to 2 trades, which means that once I hit this limit, right? Once I've taken 2 trades, EdgeFlo automatically block me from trading by graying out this trade button. I would not be able to press this trade button once I hit this limit or once I violate any of my guardrails that I've listed right here. And then the next guardrail I have is my trade plan, right? So when I am trading on EdgeFlo, I'm gonna be follow the charting process right here, right? So I'm gonna literally check off step by step. Once again, this ensures I'm adhering to my trade plan as I'm trading. And then once that's done, right, once price comes down and sweep the Asia high or Asia low, this is where I'm going to look for my entry trigger, right? I want to see this, and I also want to see this, which means that if I see one of my trigger, but I don't see the other trigger, I will not enter, right? So this forces me to follow my trade plan as I trade, okay? And this is the most important thing ever, because now you actually have structure and order in your trading. Now you can actually execute your trade plan consistently so that you can actually get consistent results. And if I don't follow my trade plan, EdgeFlo will actually flag it to me right here, So I know that, I've been a bad little boy on that particular day itself. And the third rule is that I always use a fixed risk per trade, right? Which means that I only risk 1% of my entire account on any given trade itself. So on EdgeFlo, this is something that you can choose in your settings, right? You can select what's your preferred risk per trade. And then when you start trading, all you need to do is to come here and you place your stop loss, and EdgeFlo will automatically calculate the lot size based on your risk per trade itself. So you can enter straight away with ease while adhering to your risk parameters, right? So in this particular case, 1% of my account is 42K, and EdgeFlo has told me that, okay, the lot size that I should be using on this particular trade is 15.9 if I want to make sure that I'm staying within this 1% itself. I can even ramp it up to 2%, but I need to make sure that I unlock it and I can change it to 2%, right? And then you want me, telling me that, I'm actually exceeding my risk parameters. Once again, this ensures that you stay disciplined and locked in. And if I do want to continue trading, what happens is that EdgeFlo literally forced me to type a reason, and that reason gets saved into the journal along with my overriding of my guardrails. And this allows me to review later on, when I sit down and I realize how much of a disciplined dumbass am I. Your job is a trade cleaner. It's about focusing on one good trade and then followed by another good trade and then so on and so forth. That should be your mentality when you are trading. Because trading is one of those few endeavors where you don't get paid based on the amount of hours that you work. You don't get paid because you work hard. No, you get paid by the quality of your decisions, right? So it's not about more. It's about making the right decision at the right time, at the right place. Now, before we end here today, I want to share with you 3 common mistakes that every beginner tends to make. And honestly, I care about you way too much. I don't want you to be losing money. I don't want you to make stupid trades. So I'm just gonna tell you the mistakes up front, right? So that you don't make these mistakes. Mistake number 1 is marking Asian session wrong because you keep changing the time window. For Asian session, it's 7 p.m. to 3 a.m. Eastern Standard Time. Another window you could trade is from around 8 p.m. to around 1 a.m. Eastern Standard Time. Okay, so that would be another window which is a little bit more tighter. And once you choose the window, you want to stick to it, right? But you don't want to switch around. You don't want to switch from the first window to the other window or so on and so forth here and there because you feel like it. No. Once you stick to one, stick to it, right? So for me, I prefer the 7 a.m. to 3 p.m. because that really encompasses the entire Asia swing range. Mistake number 2 is entering while price is still outside of the range. No re-entry confirmation. This is exactly what I've just highlighted to you guys. When price is still outside of the range, as much as possible, you don't want to be entering. What we do want to see is something just like this, right? This is the perfect scenario right here, where price break out the range, sweep liquidity, and now it's back in the range. And this is where you want to make your entry. But in this particular case, as much as possible, try not to enter when price is outside the range. You are much better off waiting for price to come back into the range, just like what I've done right here, and then making your entry. But if you want to enter when it's still outside the range, you can, right? I've showed you how to do it, but just know that it's a little bit more aggressive. In fact, it's very aggressive because price can still continue going down since you haven't returned to the range itself. That mistake is putting your stops inside the box and getting wicked out, right? I see a lot of people, they actually place a stop loss at the wrong place, right? They either make it too tight, right? They place it right here. And then what happens is that later on price came down here, swept the liquidity and continue going up and they get stopped out, right? Or they place it, too far away, all the way down here, right? So it's the stop loss placement is very important because amateurs focus on entries while professionals focus on exits, right? So you want to make sure that you place your stop loss at a price point which invalidates your trade ideal. Not wherever you want to place it at, not placing it inside a box because you feel like it, not placing it here because you want to get a 2R take profit. No, place it at a price point that invalidates the trade ideal, and more often than not is usually below or above the liquidation candle, above or below the candle that swept liquidity. Alright, so I will end off by giving you one final advice. Alright, just one final advice that I wish my younger self knew. And this is the part that most people miss or most people don't talk about. The setup isn't what makes you profitable. Your discipline is. What I mean by that is that you can copy someone else's strategy. You can copy someone else's setup. But you can never copy his psychology. And that's the important part that makes the strategy work. It's you can follow the exact same trade plan as what I've just laid out for you right here and still lose. because you didn't manage to control your emotions. You could follow the exact same plan as Warren Buffett and still get vastly different results. Because it's not his strategy that makes him great. It's not the strategy, not the setup that makes him the best investor of all time. It's his temperament. It's his patience. It's his focus. It's his discipline. And last but not least, just understand that you don't become successful from one winning trade. It's built over thousands, executed with the same rules. Even when you're bored, even when you're tilted, even when you're down on the day, especially when you don't feel like it. Because every single time you follow your trade plan, you are casting a vote for the trader you are becoming. Which also means that every single time you break your rules, you are casting a vote for the version of you that stays inconsistent. So the next time you're about to click the buy and sell button, pause for 2 seconds and ask yourself, is this a vote for the trader I want to be in 1 year from now? Or a vote for the trader that I'm trying to leave behind? Because no trade is wasted. Every single trade is essentially a vote for the person that you want to become. So you are either reinforcing the identity that is gonna serve you, or reinforcing the identity that is gonna destroy you, right? So make a choice. Choose wisely. So that's it for this lesson. If you've enjoyed this lesson, I'm pretty sure you're going to love this playlist right here where I go through more market mechanics strategies just like this. So go and check it out. And as always, remember, you're just one trade away. Mwah.